Okay, you've just made some money from selling your business. Congratulations. But now you're realizing you need to make your wealth bulletproof by figuring out how much to spend, how to optimize your taxes, and how to create an investment portfolio that not only grows your wealth, but protects it. Now, ideally, you should be working with a wealth manager, but if you are an entrepreneur, you might also have that drive of wanting to do it yourself. So here's an approach that I would recommend to you if you do decide to do it yourself. Before I dive right in, I should quickly introduce myself. My name is Daniel, and I have over a decade of experience in the investment world. I'm a chartered alternative investment analyst. I have a master's of finance. I was an investment analyst at S&P Global, and I've published papers on predicting asset prices that made a significant impact in the field of behavioral finance and investing. But most importantly, I've spent all these years studying markets and developing the tools to consistently outperform them. Okay, so first, let's set some rules to preserve your wealth and to also allow it to grow. You need to follow the 4% rule. The 4% rule means that you can only spend 4% of your net worth every single year for your general living expenses. Why 4%? Well, generally, a standard investment portfolio will grow by 5 to 10% every year. So keeping your living expenses below that makes sure that on average, your wealth will continue to grow in the long term. So if your net worth is, let's say, 5 million, that means you can live on approximately $200,000 every year. And if your net worth is $10 million, then you can live on $400,000 every year. Now, there is an exception to that rule. If you have some other form of income, such as another business venture that's providing you income, then you can just live on that or supplement it with the 4% rule. And you can reduce that 4% if you do have other income. Now, you could also technically increase that 4%, but the 4% itself is on the upper limit. The majority of financial advisors are not very good investors. So if you want to increase your living allowance to more than 4%, I really don't recommend it. You typically can get access to the better wealth managers once your net worth exceeds 5 to 10 million. The problem is that most money managers all get the exact same financial education, and then they apply all that same knowledge, which results in lower average performance since markets are always adapting. So ideally, you're looking for a wealth manager that not only applies the standard education required, but that they also apply their own strategies or have their own edge that helps them outperform. Now, the second thing that you need to focus on to protect your wealth is tax optimization. Once you become a high net worth individual, it makes sense to apply tax strategies to reduce your overall tax burden. Now, ideally, you change your tax residency, since that can bring you from a tax rate of 40 to 50% to essentially zero, depending on where you choose your residency. But obviously that doesn't suit everyone. But most people do have many other options to reduce their overall tax burden, regardless of their physical location. And therefore, I do really recommend enlisting in the help of a tax advisor who specializes in helping high net worth individuals. Do not go for your standard local tax advisor. You want to find someone who has helped many people in the exact same position as you. So when you do find a tax advisor, you should be asking them questions such as if they've worked with entrepreneurs or high-performing founders before, and especially also people in the same net worth bracket as yourself. Now, another important thing to talk about are legal structures and protection. If you're serious about bulletproofing your wealth, then how you hold your assets is almost just as important as how you allocate them. The right legal structures can protect you from lawsuits, creditors, the government, and excessive taxation. At a minimum, you'll want to separate your personal assets from your investment holdings. This means using entities like LLCs, limited liability companies, and trusts. For things like real estate, holding property through private companies limits your own liability. And then trusts, for example, can provide estate tax benefits and shield assets from legal claims. So if you want to protect your wealth from things like lawsuits, predatory litigation, things like that, consider offshore asset protection trusts in jurisdictions like the Cook Islands, where creditors can face extreme difficulties in being successful with their lawsuits against you. For entrepreneurs that have just sold a business, tax-efficient legal structures like family offices or private holding companies can help manage and protect capital while also reducing tax exposure. The key isn't just making money, of course, it's keeping it too. So you should get an asset protection strategy in place before the problems arise. Okay, now one of the main forms of protecting and growing your wealth is in terms of your investment allocations. Okay, so let's run through some of the best practices for allocating your wealth depending on your net worth level. Now remember, these allocations are not specific to you, they're just a generalization to help guide you in the right place. For the first example, let's say you have a net worth of $5 million. So here's the move. We want to allocate 70% of that towards a wealth preservation bucket. This is your stay rich money. It's your foundation. So within this bucket, 30 to 40% of the money should focus on blue chip dividend stocks and ETFs. These give you liquidity, a hedge against inflation, and a little cash flow. Then, also in that bucket, you should allocate approximately 20% towards bonds. Something like investment-grade corporate bonds are perfect here. Then finally, you want to allocate 30 to 40% of this wealth preservation bucket towards real estate. So specifically, income-generating properties. You want assets that appreciate, but also pay you while you sleep. So overall, this segment actually generates you an income from dividends, rent, and bond yields. It should help produce some, if not all, of the money used in the 4% rule that we discussed earlier. Now, next in our allocation is cash. So I would recommend, let's say, 15% allocated towards cash. This isn't just a safety net, but it's also your opportunity fund. If a really good investment opportunity arises, you're going to be ready to capture it because you have the cash ready. And also, of that 15% we've allocated to cash, the portion of that, remember the 4% rule, that also covers your living expenses. You just don't want to spend more than 4% of your total net worth. So really 11% is what's left for you to be able to spend on opportunities to invest in. And then finally, the remaining 15% we allocate towards your growth portfolio. This is where we're talking about actually making money and growing your wealth. Now, it's important to say that this is not your gambling portfolio. This is where you take highly calculated asymmetric bets, where the downside is limited, but the upside is huge. So for example, you want to include high quality growth stocks here, and I'll give you a key insight. The best investments over the long term are typically technology stocks, but it's not how you should look at them. You should look at the best investments as productivity multipliers, things that help people do more, faster, or better. 100 years ago, steel and railroads were known as technology. Today, that's blockchain, energy, and AI. So don't think tech, think productivity. The financial world mislabels this industry as risky, but it's completely wrong. It's where the biggest opportunities are. But this also doesn't mean to blindly invest into something such as MicroStrategy or Nvidia. At the time of this video, these stocks have already gone up so much in price, but I'm just using them as examples, as since when their price was a little bit lower, they made great investments. You want to be ahead of the next biggest trends and invest when the prices are low. If you want to nail this part of your portfolio, that's where having exclusive access to our private wealth desk can help you with including asymmetric opportunities within your investment portfolio. And if you're not ready to work together yet, but you are at the $5 million net worth level, you're welcome to check out the video that I've made on how to manage a $5 million portfolio by yourself. So now let's talk about if you have a $10 million net worth. At the $10 million level, we start to play a different game. You're going to be able to leverage it a little bit better by getting access to investments that were not previously available. Okay, so again, let's have our wealth preservation bucket, but we're only going to make it 50% of our total portfolio. So again, 40% towards stocks. This includes index funds, blue chip companies, dividend stocks. Now, dividend stocks typically range from giving yields of 0.5% up to 3%, but be careful. If a company pays high dividend yields without showing much price appreciation, you're basically taking on the risk of a stock and only getting the returns of a bond. Don't fall into that trap. Then within this wealth preservation bucket, we want to allocate to bonds again, so 20%. And we want to be adding high-grade corporate bonds here or bond funds. And like I said earlier, it adds stability and cash flow. Then the final allocation within the wealth preservation bucket should be 40% towards real estate. So rental properties, real estate investment trusts, or private real estate funds. And the reason for this is as an inflation hedge, passive income, and capital appreciation. So what's different in the $10 million net worth bucket compared to the $5 million is you now should be allocating 20 to 30% of your total net worth towards alternative investments. Once you hit the $10 million net worth level, you get access to other investments. You unlock deals that regular investors can't touch, things like private equity and venture capital. Ultra high net worth individuals typically allocate 25% up to 50% to alternative investments because these can deliver outsized returns and diversification. However, at the $10 million net worth level, your allocation should be significantly less since these investments are typically quite illiquid, meaning that if you need to pull out cash fast, you can't, or you have to pay an early redemption fee. So for this bucket, you only want to invest what you're willing to be able to lock up for 5 to 10 years. Then the next part of your net worth, it should be held in cash. Since your net worth is a lot higher and you've been able to allocate to alternative investments, you can allocate just a little bit less to cash compared to the $5 million net worth portfolio. So let's say we allocate 10% to cash. Your reserves are going to be kept in high yield savings accounts or short-term treasury bonds. The purpose of cash remains the same. This is used for your living expenses, but it's also your opportunity fund, where you'll always be ready to deploy cash and take advantage of opportunities. And then finally, you're going to have a growth portfolio that's worth maybe 5 up to 20% of your net worth. This is where most of your returns are going to come from. Realistically, you can get 20% annual returns with this in the long run if you play it correctly. Now, that's if you're working with a really talented investment manager that only the ultra wealthy can get access to. But if you're doing this yourself, keep this allocation to 5%. If you work with a talented investment manager, then you can scale it up to 20%. If you'd like exclusive access to your own private wealth desk with Seneca Private, where we can help build a high growth portfolio for you, check out the link in the description, or you can visit senecaprivate.com/apply. For example, in my annual investor letters that I've sent to friends and family since 2020, and now Seneca Private clients, I've helped people get in early into investments such as renewable energy in 2020, which secured approximately a 300% return. I also recommended Bitcoin in 2020, which at today's prices is securing a 987% return. And I've also recommended certain tech stocks back in March of 2023, which now have a total return of over 100%. So anyways, these are the two main risks when allocating your wealth. Number one is taking too much risk and then getting wiped out. And number two is playing it too safe and never growing your wealth. It's a game of discipline, but if you play it right, you'll bulletproof your wealth and set yourself up for generational success. I hope this video was useful for you, and I'll see you in the next one.